Good morning. Welcome to the morning market briefing. Today is Friday, April 24th, 2026. I hope you're doing well. It is beautiful outside. It's going to be a very interesting day. Yesterday was a very interesting day as well. So we talked about Wednesday technology stocks ramping up while everything else sold off. Well, yesterday was quite the opposite. Some technology stocks did do well, especially on the semiconductor side, but software really got hit. It was a Citrine report take two, I would say, if you're really summing it up. And what that looks like is all of the things that people were concerned about AI disrupting emerged to the fore once again. So we'll just kind of take the news one at a time. But basically what we had was a raft of layoff announcements yesterday throughout the day, really catalyzed by Microsoft about midway through the day, that brought a lot of stocks down, including companies that had reported earnings that had done okay, but were caught up in the landslide lower. So I think there's really interesting categories of layoffs going on right now. On one hand, you're seeing some baby boomers being shown the door with a knife firmly prodding their backs. You have other companies going after what they would deem as lazy, overpaid youth. And then you have other companies just saying, we're going to cut headcount with a sledgehammer. And I think this, Thomas, you were talking about this yesterday. You would take the over on pretty much any unemployment forecast out there. And I think that would align with what Tom Russell would say as well.
Yeah, I would tend to agree. And I think that the additional layer to consider for that too is not only are we seeing these layoffs for the elderly section and the young unproductive section, but even really high qualified candidates, these companies are also not hiring too.
Meta just took off 6,000 jobs that were on the board. 6,000. The company only employs 80,000 people.
And this is after this is the second round.
Yeah, we'll get into that in a second too. And yeah, I mean, and I think that there was a big article in the FT yesterday that was talking about this and said the people who are earning the most money right now are the ones who are using AI, and the people who aren't are getting left behind. And I think that this is happening faster than most people realize. What we're doing at Narwhal is we're trying to adopt AI, and what we can do is, and we're doing this for some clients, and I think we'll probably continue to do it, is basically just show clients what we're doing and friends of the firm what we're doing and how we're doing it, and doing it in a risk controlled way. We're not just going wild west and allowing all these AIs onto our platform or anything like that. In fact, we're not giving them any access. But what we are doing is we're trying to use artificial intelligence, and we are using it. I mean, it's incredibly effective. And we are using it to make ourselves more productive and provide better services to our clients. And I think that a lot of other companies can do that, but it does take initiative to go do that in a concerted and disciplined manner.
Yeah, definitely. I think that it's definitely a combination of a lot of companies are too scared to adopt it, and then the ones that currently aren't doing it properly or really aren't aware of a lot of the safety concerns, especially with like a lot of the local downloading software that's being pushed pretty hard by a lot of the big companies right now.
Mm-hmm. And it can be force-fed by upper management too, which is also unhealthy. So let's take them one at a time. First of all, Microsoft announcement was voluntary retirement for 7% of its workforce. So this is going after the boomer generations. It's only eligible for senior director or lower title. This is according to CNBC. And basically, you know if you're eligible if you take your years of employment plus your age, and that equals 70 or more. So take, for example, the person who's 50 years old who's worked at Microsoft for the last 20 years. This person would be eligible for retirement. And we don't know exactly what that package would be, but essentially then a spokesman for Microsoft wrote a memo and said, quote, "Our hope is that this program gives those eligible the choice to take that next step on their own terms with generous company support." In other words, in my opinion, we hope you take this deal for your sake, because the implication of saying those eligible, take the choice to take that next step on your own terms, because it's not going to be your own terms for long.
Yeah, take it while you have the chance before it's too late.
And it's probably going to be about 10,000 jobs or so. Deloitte tried this, interestingly. KPMG tried this with its partners. They only have 1,400 partners in the entire audit practice, so it's not a huge number, but people just weren't retiring. They were on the gravy train. They weren't doing a ton of work. They were making lots of money on the audit side. And so no one was actually taking the offer. So now KPMG is saying, we're just going to cut 10% across the board of our partners, not like people who are partners of the company. Like this is like tenure in the Big Four space. And so the FT reports KPMG is cutting about 10% of its U.S. audit partners after years of failed attempts to urge more of them to retire early to improve productivity at the accounting firm. So they were told the action was needed because the size of the partners. So it's this is all that they're getting rid of the most highly paid employees. Both Microsoft, KPMG, the most highly paid unproductive employees. And then if you look at Deloitte's on the other side. I think Deloitte is, so sticking with the Big Four, they're cutting benefits and things that tend to be valued more highly among the younger employees, but specifically among the younger, less productive employees. So, for example, what they're doing is they're cutting benefits. So all the parental leave, we know how we were going from 4 weeks to 8 weeks to 12 weeks to half a year in some places. Well, Deloitte currently had 16 weeks. They're taking that down to 8 weeks. And this is all parental leave. So that includes maternity leave, which I think 8 weeks is pretty low now.
I would say industry-wide, it's pretty low.
Yeah. I think there's a lot of paternity leave that inflated all the way to 8 weeks or more, especially during COVID. They're reducing paid time off from 15 days to 10 days. It's a big reduction, 33%. They're eliminating $50,000 in IVF and adoption reimbursement. They're freezing pension accruals for employees in internal support roles, so administration, IT, finance. This is a company that was up 8% in revenue last year, and they're just slashing benefits. They're just saying, if you're not part of us, if you're not here, and you're not working, you're not bringing in revenue, you're a cost to cut. And I think the bringing in revenue is important. And I think that many people would be well served, especially in the younger cohorts where Deloitte's going after right now. Many people would be well served to try to understand the value that they're bringing for their company. And if their current compensation is justified by the value that they bring that business.
And especially with these, I applied to Deloitte back in the day. And they were a company that, like infinite benefits. You can't even name off all these things. It's like, oh, well, you don't even need to drive. We'll Uber you back and forth to the office every single day. It's going to be lunch every single day for everyone. This is the best company ever. And then when you think of, it's such a competitive environment, you're rotating into this space where a lot of their entry-level positions, you can have an agent do data analytics and tell you to fire a certain amount of employees at a company, which is a large majority of what some of these consulting firms do. So I think that a lot of these companies now are taking a step back and be like, all right, deal space was good. We were getting a lot of business. Now these companies can even hire like basically third-party consultants, like smaller agencies. You can run the same capacity of analysis with your own agent at like a smaller consulting company or something like that. So like, all right, we need to take a step back, cut our costs, and I think rework the whole business.
Yeah, I think you're exactly right. We're seeing that KPMG, we're seeing that Deloitte, interesting different strategies there, but both of them going after it. And then Meta, another 10% layoff. It was started to leak. They're doing this around May 20th, but they said, we got to write the memo now because it's all leaking out. So this will be about 10,000 jobs, plus they're closing another 6,000 open roles. They say, normally we would want to nail down more details before communicating, but since it's leaked, I want to share what I can right now. It's part of the continued effort to run the company more efficiently and to offset the other investments we're making. They'll give generous severance, which includes 16 weeks base pay plus 2 weeks for every year of employment. So if you've worked there 10 years, you're going to get 20 plus 16, 36 weeks, almost half a year. of severance, and they will give more details on May 20th. So they're taking a sledgehammer to the whole organization. KPMG going after the old, overpaid boomers. Deloitte going after the young, overpaid people who don't bring in revenue. And Microsoft saying, kindly, please leave, or else.
Yeah, and on the Meta thing, I mean, they gotta find some way to offset the token maxing.
Mm-hmm.
I mean, you got one side of the coin. Some people in your business aren't making you any money, and the other side, you're like, here's infinite money, spend it all as fast as possible.
And I would just say, I mean, I think that corporate America is very trendy over the last 6 to 7 years, and I think that trend is reversing. And I think people are realizing corporate America is corporate America. And there's a reason people, quote, quit the corporate grind. And I think that it's not necessarily all work from home, 4 days a week, take whatever time off you want. And we're starting to see that in real terms. And I think what's interesting too is, we talked about it before, but for those of you who are managers or own businesses who are listening to this call, there are two ways about going about increasing productivity. Either Deloitte could go to its younger employees and say, look, you're a cost right now. You need to increase your productivity, or you need to bring in revenue. And here's how you can go about doing that, and really set a path to elevate those employees. Or you can just cut the headcount. And I think they're doing a lot of corporate America just defaults to the latter because that's how they're programmed. But I think a lot of business owners, and especially small, more like family-run businesses or small private companies, I think this is where you can say, no, we're different than that. We want to elevate you. Yes, this is a threat, but you can actually turn it into an opportunity. And here's how we're going to do that. And it does take a lot more work on the part of the manager, but I think that you can create a more productive, vibrant business with higher revenue and higher profit than just slashing headcount. And so I think those are the two options that people can take. Obviously, corporate America, I mean, they're not, most businesses don't employ this many people who are paid this well.
Yeah, I agree. And I don't know, at least from my perspective on the whole employment thing, I think we might just be getting started. This might have been the first wake up, because there's a lot of big tech companies that are spending a lot of money and have a lot of people employed.
So we're 4.3% right now on the unemployment. Where are we by the end of the year? Maybe give you your base case and then your tail.
I would say my base case is probably 4.7, 4.8. And I would say we could, I don't know, depending on how it's calculated, I would say we could get over 5.
I think Tom would be right there with you. So we're seeing all these headlines, and it's having the same exact effect that the Citrini report had earlier this year. So you had software getting smashed. Obviously, we had the ServiceNow report yesterday, but really, ServiceNow was down more because of this, I think, and then anything. And then you also had American Express. They had a good number. They actually implicitly raised guidance for the year, and yet their stock was down 5% because they said white-collar workers are going to not pay their bills. American Express actually had to talk about this on their call. They said, guys, the last thing I'll say is a lot of people talk about white-collar. They didn't say guys, but I'm injecting my own thoughts here. Talk about white-collar workers. Our base is not just white-collar workers. Our base is premium consumers and premium small businesses. Includes the individual entrepreneur to the TikToker and to the influencer and to the podcaster. I don't know if that it infuses confidence among the investors. They say, but again, technology has over time fueled GDP, not crushed GDP. And then Blackstone was down 6%. They had to ring fence their software, which they didn't do until the conference call was almost over. And they said that software is about 7% of their firm's assets under management. I think in both of these cases, American Express and Blackstone, both of which were both long, these are not investment recommendations, but I think in both of these cases, I think I would agree with the management teams here, but it's just a tough message. And Blackstone did themselves no favors when the CEO, John Gray, came out with a video, and I don't know if it was on TikTok or what it was, but it was about 90-second video saying our top 3 things for the quarter, and he gives his top 3 things. And then they had all these kids, like kids of the people who work with him, like in the audience. And then one of them had a question. They say, can you expand on private credit? And he said, of course. And then he didn't.
Next question.
And then he didn't expand on. And then he's like, look at that baby over there. We got to end it with that. And that's how we finished it. It was terrible.
It was bad. It was.
I mean, it was. I at first I was like, man, okay, they're really doing this to cover their tracks on a terrible conference call. I mean, they just really bungled that conference call. It was low direction. They weren't organized at all, and then they did that to try to cover themselves, and then they made that look even worse than the conference call.
I mean, see, the conference call is only sort of staged to an extent with the analyst answers, but if you're going to stage a video, it should probably be a little bit better.
Semi-stocks, though, and cyclicals absolutely ripping. This is going to be a theme that we're going to continue to talk about. So, again, out with the AI, there are 2 themes that we're going on right now. And this is the same in the private market as in the public market. This is where the multiples are highest in private markets as well. And that is if you are a key lever to AI, if you're an AI company, or if you are totally apart from anything that could be AI disrupted. I was talking to a buddy of mine. He owns a body shop and auto body shop, and he was like, you know, it's a beautiful, like, private equity loves these businesses because it's AI. I mean, it's totally immune from any AI risk. So we're starting to see how this permeates. So yesterday, semiconductors ripped because they are enabling AI. Even in this morning, we had Intel up 24% pre-market. They're saying that Elon and I share a strong conviction that global semiconductor supply is not keeping pace with the rapid acceleration demand. They say our confidence in the sustained growth of CPUs driven by the AI infrastructure build-out is growing. So they raised guidance. Max Linear, ticker MXL, is up 43% pre-market. They're not even getting, like, they're not getting bought out. They're not doing it. They just are seeing accelerated adoption of the newest products, improved visibility and bookings. And they say we also expect a step function data center revenue increase beginning in Q2.
I wonder if some of these gains, too, are just people that fell for the software apocalypse yesterday and are like, I need to put my money somewhere.
I think
these
a lot of
insane.
Yeah, I mean, it's wild. But power semiconductors are, I mean, we own Analog Devices, which unfortunately doesn't have the same degree of leverage. I mean, it's just a very, very, very high quality company. And so it's already priced well. And they're an off-cycle report, so they won't report till next month. But they're going to benefit from a lot of these trends also. And the stock is up, I think, 40% or 50% in the last month. So not too bad there. Industrials as well, though, absolutely ripping. We spoke about it, United Rentals, yesterday. They didn't have their conference call until after our call. And they said it's not just data centers, guys. It's strong growth led by non-residential construction and infrastructure. On the industrial side, power and mining and minerals. They say the year is playing out better than expected just a few months ago. We continue to be optimistic, particularly for large projects. It says, and non-residential construction overall, even excluding data centers, is still really strong. The growth in non-residential is pretty broad. I mean, this is a theme when you look at Union Pacific, when you look at CSX, Carlisle, the building materials provider, reported this morning saying that April activity to date has been encouraging, and they exited March with better momentum than we entered the year. So all of this is really good news. We had the AIA Architectural Billings Index, which posted its highest number since I can remember. They're seeing growth across sectors, commercial and industrial, at 52.5. First time it's really grown since 2022. So all of this is CapEx build is coming, and people want their infrastructure, and they want their industrials. They want their tech semiconductors. They don't want the software.
Yeah. I mean, and we're also seeing this growth. We're seeing an acceleration of oil, too.
Yeah.
So
Yeah, which is impressive. I mean, which usually you would think would be the opposite because that's a cost. That's
Yeah.
an input cost for these guys. And then finally, flights are resuming out of Tehran to Muscat and Istanbul. These are commercial flights. I don't want to read too much into this, but I don't think that you would start commercial flights again if you were concerned that there were missiles flying all over the place. So I'm optimistic that there'll be something. We have seen reports about some Iranian ministers going to Islamabad and Pakistan to meet with the U.S., so we'll see what happens with that. We talked about it yesterday. I do think that there is a potential for something to happen this weekend. We'll see what happens with that. Next week is going to be incredibly busy on the earnings front. We have all the big boys reporting, except NVIDIA, Google, Microsoft, Meta, Apple. Is Amazon? Amazon. Yeah, on Wednesday evening, we have Google, Meta, Microsoft, and Amazon all in the same evening, and then Apple the following day. So
and all the industrials almost.
All the industrials, Visa. I mean, it's a who's who. Caterpillar, Eli Lilly, the biggest companies in every sector basically report. So that'll be fun. And we get an FOMC rate decision on Wednesday as well. So we got Google all on the same day, guys. We have Google, Microsoft, Meta, Amazon. We have Old Dominion, the LTL company, and we have a rate decision all on the same day on Wednesday. And then next morning we get Eli Lilly and Caterpillar, and MasterCard.
Big week.
Enjoy the weekend. Rest up. It'll be a fun one next week. Hopefully we get some more color on Iran, and hopefully it comes to hopefully we start moving through the process. All right, bye.